The last time that I spoke to Shankar Sharma, he was constructive, selectively constructive, if you will. A lot has happened since then. It's been almost 3 months that I last spoke to him, and therefore it's great pleasure to have him on the show today to try and understand how is he feeling about the investing landscape currently. Shankar, always good having you. Thanks so much for taking the time out.
Thanks, Rish. Thanks for having me.
What's your sense, Shankar? A lot of moving parts currently. Are you constructive or are you cautious?
Well, as the Chinese saying goes, may we live in interesting times. So I think we are continuing to live in very, very, very interesting times. And just when you thought that the Russia-Ukraine war and its aftermath and its effect on inflation and energy prices and everything was in the rear view mirror, and we are looking forward to a relatively calm period ahead, and then SVB and SCS, and I don't know, I hear about many other banks across the United States and in Europe being in trouble. So like I said, maybe continue to live in interesting times. But on a more serious note, I mean, my view on the global macro is that we have a problem. What I definitely don't want to sound is flippant, in the sense that I remember back in, and it's important to go back a bit in history, in the 2007 fall, which was August, September 2000. No, I'm not talking fall as in the market fall. I'm talking the season, the fall season, the fall, right? And that was in August 2007. I remember distinctly when the very first murmurs of a problem in the subprime market came out, and which was when Bear Stearns shuttered, I think, a couple of their funds. And BNP Paribas in Europe also, I think, stopped redemptions of maybe one or two of their funds, which were investing in subprime assets. And that was like a very, it was just almost insignificant. But if you were an astute observer, you would say that there is something going on there, which may or may not have happened led on to 2008. But at least it was a canary in the coal mine. And SVB happened to be the subprime equivalent in today's era. And in fact, it was a subprime bank. If you're lending to startups, you are lending to subprime. I mean, there are no prime borrowers in the startup market. We know that, right? I mean, they're all basically hand-to-mouth, cash-starved companies, which is similar to the Jamaican maids in Bronx or in Queens who were getting mortgages from all the banks back in 2007. So the parallels are fairly eerie. Okay, I'm not saying it ends that way, because central banks have learned the lessons from 2008. They're moving quicker. Back then, I think there was a fair amount of delay between the problem identification and the actions. I think now the Fed is far more, on the ball. They're moving quicker. So I think the problems will be contained, but there is a problem for sure on the global macro front.
So, Shankar, is it possible that there are a lot of imponderables for this problem, which may result in a risk of or accidents being a lot more pronounced than what is apparent to the eye currently?
Risk off is definitely an on trade, and the imponderables, like even Credit Suisse, ordinarily in an ordinary situation would not have caused this much tremor. So again, understand this. I've always said this, and I believe firmly in this, that in any market situation, there are enough reasons to be bearish and there are enough reasons to be bullish. Okay, permanently so. Across market periods, you can find adequate bear arguments and bull arguments. The market will choose the argument it wants for that particular phase, depending on how the market itself feels. And the market has not been feeling good for the last 12 months. In fact, maybe the last 18 months, right from, I think, November of 2021, when inflation started to pick up and fixed income and the Fed started to tighten quite aggressively. Go back in time, fixed income part of the market started to collapse. And I know that because I lost money then. So I was hurting because of those decisions by the Fed. The market has been hurting. In a hurting market, a thing like a Credit Suisse or an SVB will assume bigger, larger than life proportions because the market wants the bad news. It is loving the bad news. It doesn't want to climb the wall of worry. It wants to succumb to the worries that the market is throwing its way. It is just that phase of the market. Last 18 months have been like that. Unlike the previous 18 months after COVID, when you could do no wrong, markets were climbing wall after wall of worry because the market was very sprightly. It wanted to welcome bad news because it could deal with it. Now it doesn't. It's unable to deal with it. So it's hurting it. These pieces of news are hurting the market. It's just the phase of the market that is making the events look very important. In a raging bull market, these things would be brushed as, okay, oh, aisa hota hai yaar. You know, a couple of banks going under. It's okay. We have balance sheet. We have firepower. The markets are jittery. And I don't think the jitters are going to get calmed anytime soon on a global basis.
This ties in with a thought that Shankar had expressed in the past. But you look at the history and the markets are primed for something, then it looks for reasons to suit its narrative. Shankar, my question therefore would be, I've heard multiple people who are usually very skeptical or who have been skeptical on India for the last few months now talk about how the valuation argument at least is not as adverse as it was. We are probably not even at what standard deviation, but even lower than that, maybe 5% lower. We come into a zone wherein India starts to look like long-term averages. Is that an argument enough to chip away, even if mid caps and small caps or otherwise? Or do you believe the chances of the accident are higher and therefore there is enough time to look at things and then deploy the gunpowder to work?
It depends on what kind of investor you are. I mean, if you're a large fund, you need to keep all these things in mind because inevitably you will be exposed to the larger caps of the market. Okay, you can't deal with small caps and hope to make a living because they will not be able to absorb the amount of money you have. But if you're an individual investor, I don't think you need to worry about this valuation premium shrinking or expanding or doing all kinds of things because I remain extremely bullish on the small cap end of the market. Nothing has changed. If anything, my belief has been strengthened more because of the last quarter's GDP numbers, which were very soft. I'm talking India now, which were very, very soft. I mean, also remember this whole thing about 7% growth and all that is not correct. It's the equivalent of a retail company in India, who shall remain unnamed, whose no two quarters were comparable. So you could never compare current quarter to last year's quarter because there used to be a spin-off or a divestiture or a merger or something. So uska koi do quarter comparison tha hi nahi. There were no normal quarters that you could compare. So here again, the 7% is coming because 3 quarters are abnormal quarters and hit by the COVID wave 2. Okay. And therefore that optically inflated the growth rate. But the real numbers that came through were, let's say, a fully functioning quarter was December 2021 quarter. And then we had the data for that, the same quarter in 2022. And that data is not flattering. We saw that come out, the 4.4% or whatever the number was. My take is 2023-24 full year may well be a disappointing year by way of headline GDP growth. Because it's very clear, Neeraj, again, we have to look at the data for what it is without getting into that we cannot be critically analyzing data, because I've tweeted this, that we need to have critical thinking on macro data without getting fingers pointed at you that you're belonging to X party or Y party. Back in the day, that was never the case. I don't know why that is suddenly the case now. Looking at the data neutrally, the reality is that India is facing a problem on the export front. I mean, we cannot be exporting in an environment when your importing countries are in this kind of a recessionary grip, right? It's impossible that you can grow exports. And February data shows that, that it was what -8% or so of export decline. That is a big problem, because if net exports don't grow, you have a hit on the GDP growth. What you're left with is domestic market and domestic consumption. That, by enough data points, are showing to a softer situation happening. Okay. Rural demand, I talked to come. Rural demand is is very, very soft, And I've always believed that for companies to grow, rural markets have to support. India came out of the 2008 crisis very well for one major reason. Rural demand was roaring. And I personally saw that happening in late 2008 when I went around to villages and I saw massive, buying of two-wheelers and televisions and painting of houses and all that. India recovered quickly and we were growing at 9% 1 year out of the 2008 crisis because of rural demand. I believe India deserves and wants rural demand to be strong. Unfortunately, that is not there right now. Therefore, so the point is this. Headline numbers will be bad. I think they will be disappointing on the GDP front, which means that large caps will struggle to deliver big numbers of growth because large caps are inevitably a reflection of the macro. Okay, small caps, on the other hand, are completely devoid of, or not completely, but largely devoid of influences from the macro. And which is why I'm even more bullish on this part of the market as opposed to the large cap part of the market. If you look at the large caps, I don't see where the growth levers are coming from. If you look at IT pack, big problem. You look at Reliance, which the stock price is telling you enough. You look at the Adani Group, which is a big propellant of the previous move, big problem. I mean, I don't know where you're going to see, the big drivers out of the large cap pack. But in small caps, I mean, I see many companies and names, and I talk to managements, good, decent outlooks, a reasonable valuation. So I remain even more bullish on small caps today than I was probably a year back.
Okay. So quick leaves out of your answer, Shankar. I heard you say IT is a big problem. I know you're bullish on small caps. I just want to lay it out for people to understand how you think about this. If banking in US has an issue, are we looking at a problem when it comes for the IT companies to even communicate their guidance? Are we looking at missing those guidances no matter how well natured or how well intended the guidance would have been in the first place? And therefore, are we looking at shrinking of valuation multiples, which have actually come up a little bit in the months of Jan, Feb, March for Indian IT services?
So Indian IT services was hurting even prior. They had a big, great day out after COVID. It was a big bump up in margins and everything. So, they enjoyed that, but now that those gains are gone, they're petered off. And they're now normalizing. And on top of that, now you have a banking crisis. We know, or let's not call it a crisis, a banking problem in the United States or in Europe. BFSI is a big driver of their numbers. We all know that, right? And while I'm not sure, have they given any commentaries out yet? I don't think I saw anything right now. I think we will hear that in the month of April for sure when the numbers come out. But I do believe that there is a challenge, and I was reading and the interviews of the outgoing CEO of TCS. He's still a young man. He's still by no means an old warhorse or aging guy. For him to quit, citing quarterly pressures itself for me was a very telling commentary on the state of the industry. I found it, you have to read things beyond what is just, visible on the surface. Why would a guy who's still fairly young, and in supposedly an industry which has still got many growth years ahead of it, complain about quarterly pressures? That means there is a pressure. That means there are challenges. That means he can see that it'll be difficult to deliver numbers in the economic environment that he is in right now. He visualizes it. So if you read the tea leaves, there was a very interesting commentary within his whole interviews or his resignation.
Yeah, most certainly. Okay. So okay, we are looking at an issue there. Just coupled with that, Shankar, because you are, I'm presuming, an investor in the unlisted startup private markets as well, and everybody's talking about a private market funding winter. Does it actually work to the advantage of the internet businesses, if you will? Because all the free capital available to money guzzling businesses is probably a thing of the past, and therefore the companies which have survived, which are citing paths to profitability sometime in FY24, might actually have reduced competition over the course of the next few years. Are you constructive on the internet businesses or not quite?
So first of all, I don't invest much in startups, Neeraj, just to be clear.
My bad. Okay.
Yeah. No, that's not bad. I mean, that's just to clarify. It's very selective and not too many actually. But if the question is more about the listed Indian new age companies, if that's what you're asking about, I remain extremely negative on them. I don't see any reason to buy them. And in fact, like I've said, I think on your show and others as well, that if they turn profitable, that's a bigger problem because then the standard valuation metrics will start to apply. So till you're on price to sales, you're okay. But the moment you have earnings, then you have price to earnings. And I'm not going to pay 400 times earnings for commodity or commodity type businesses, which really speaking got sexed up, dressed up to look like tech businesses, but they were very basic businesses selling lipstick or selling, doing food delivery. So my view remains unchanged. These are not the places to be in. But there are many places in India, like I said, it's a fantastic market. You're spoiled for choice. I mean, just to give an example, take a look at the Siemens and the ABBs of the world. They're trading at all-time highs, even in this market. I mean, I'm just giving you some pointers that there are enough places to make money and without going out on a limb in terms of risk. You don't need to take huge risk to make huge money.
Okay. Last two questions, Shankar. Understand I can't go on. No, I'd love to, but last two questions. One is on small caps and one is on the point that you just mentioned. But let me talk about small caps. You spoke about how when you talk to companies, they're sounding fairly bullish about the business momentum that they might be having individually. I know it's a very bottom-up thing, but I'm still trying to understand. Where is it that you're finding, from which themes are you finding these companies citing a bullish trend? Because a company will be able to do well only when in some part the industry is also to an extent doing okay, right? It can't really diverge too much from what the theme might be doing. So just trying to understand, where is it that you're finding this growth?
Real estate is doing well. I have investments in companies which derive business from real estate. Real estate looks decently strong. Again, India is a large country. There will be pockets of good growth, pockets of average growth or bad growth. But some of the developers that I talk to, they're reporting very, very strong outlook for the next 12 months. And real estate, you can have a 12-month outlook that buyers are still there and they're buying. So not a problem. Again, real estate drives other demand. So you have demand for all kinds of things, piping, fitting, blah, blah, blah. Just as a corollary, they are also looking strong. And then there are, snack food companies and smaller companies which are selling in one part of India. Again, the numbers look very good. Outlook looks very strong. So, like I said, India is looking good if you look at India as a collection of markets and not as a single market.
Yeah.
So, that's the way I'm looking at India right now. And that's the way I've looked at it for the last 12, 18 months.
Yeah, and it's a point that you mentioned now. I remember on our previous conversations as well. So, Shankar, one last question. Starting multiples, you've told me in the past that the big money is made when you gain both through earnings and the multiple gains. Now, when we talk about the ABB Siemens of the world, for somebody who's looking at them afresh, starting multiples are not in your favor, right? So, is it that the best? I mean, they might still do well, but is the best time to accumulate them behind us already, or not quite?
No, I don't think so. I think in this market, like in all markets, you should be buying strength, as simple as that. Even if it comes with a trade-off of buying slightly more expensive stocks. Because valuation is a big debate, has never been settled. What is good valuation or right valuation in the stock market? It all depends. So don't even try and get into that discussion. Buy strength. Buy companies delivering good numbers, companies with good, strong commentaries, and show in the stock price showing good strength. If you basically play in these three boxes, you will build a pretty good portfolio, I can guarantee you, from now until the next 3-4 months, till we see a market which is still a problematic market. Then the dust will settle and the good guys will just break away from the rest of the pack. That's exactly what happened last year in March, up until June, when the markets were in a funk. Anybody who built a portfolio back then is sitting on a minimum of 50 to 80% gains as of right now.
Great. Shankar, lovely talking to you. Thanks for calling the wheat from the chaff. Appreciate your time and look forward to having you more often.
Thank you, Rita. Thank you for having me.
And the viewers, thanks for